Hi everybody, this is Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Bill of Pittsburgh, Pennsylvania. What is the best price to use when calculating the percent remaining time value in a covered call? The bid, the ask, or the last? Well, Bill, this is a great question as always. Let's take a look at a typical options chain to get you an answer. And I've selected a stock that's currently on our premium watch list, SodaStream, ticker symbol SODA. As you can see on the screenshot in front of you, the stock is currently trading at $51.95. Now I've highlighted a few columns. All the way to the left, highlighted in yellow, is the last column. What that means is it's the price that the last trade for that particular option was executed at. In the middle, I've highlighted the bid column. The bid is the price that we normally sell our options for. Remember in the material that I provide, sell at the bid, the lower, buy at the ask, the higher. The difference is captured by the market makers. And the column all the way to the right, highlighted in purple, is the ask column. So if we were to buy back an option, that's the column we would look at. Now you'll notice that the last column, the prices are in between the bid and the ask. For example, for the $50 strike, the $4.95 last price is between the $4.80 bid and the $5.10 ask. And this is the case frequently, but not all the time. For example, if the last column represents the last trade made on Monday, and now the options open up for Tuesday, we had overnight news and the price of the stock may have moved dramatically, so the bid-ask spread on Tuesday may have no relationship at all to the last trade made on Monday. So it's not a given that the last price will be between the bid and the ask, but frequently it is, and what it tells us, if the bid-ask spread is wide enough, we can frequently negotiate a better price. I call that playing the bid-ask spread, and I have detailed information on that in my books and DVDs. So I've highlighted the $50, the $52.50, and the $55 strike prices. We could see that the bid prices are $4.80, $3.60, and $2.60. So Bill, let's take that information and feed it into the multiple tab of the Ellman calculator. And here we have in the screenshot in front of you, the information is fed into the blue cells on the left-hand side, and the calculations appear on the white cells on the right-hand side. The return on your option, the time value return that you're asking me about, is the row column, return on option. That's 5.7%, 6.9%, and 5.0% for the three strike prices that we looked at. Now you'll notice that the in-the-money $50 strike also provides downside protection of that time value. And the two out-of-the-money strikes, the $52.50 and the $55, have additional upside potential should the price of the stock increase up to the strike price by expiration Friday. So Bill, let's summarize. In order to calculate the percentage of time value remaining on a covered call, we look to the bid column. However, if the bid-ask spread is greater than 10%, we will oftentimes try to negotiate a better price using the leverage of an SEC rule called the show or fill rule, information highlighted in my educational material, and frequently we can get a better price than the published bid. Once you have that information, feed it into the single or multiple tab of the Ellman calculator, and the percentage returns will appear. So Bill, thanks so much for that great question, and thanks to all of you, our viewers, for watching this video. I hope you found it useful. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.